Welcome back, you guys. Thank you so much for joining Andy the Banker Show again. Today's episode, I wanted to discuss a little bit into the four stocks that I invest into, and just a little bit more of clarification on why I invest in these four particular stocks. All right, and in case you guys are new to the channel, the four stocks that I do invest in are Microsoft, Costco, Google, and Chipotle. All right, let's start it off with Microsoft first. Why do I invest in Microsoft? Well, there are many reasons. All right, the very first one being that Microsoft to me is a predictable stock. It has made money during 2020, that even during good times it makes money, and in bad times you still make money because a lot of the services that Microsoft does, to me at least, they are essential. You can't just turn off your cloud data computing during a recession. All right, you still need to operate your business. You still need to utilize Microsoft emails, Microsoft 365. Those are all essential businesses, as well as all the other business lines they have, such as the Xbox Game Pass. A lot of people, even during economic downturns, I can see people playing video games. That is something that I can, just because we're in a negative economy, I can't see Microsoft, the business, struggling and just collapsing overnight, because a lot of the products they have are sticky. Now, currently, Microsoft is in an interesting, weird area the past 2 to 3 months. All right. The main reason why is because of mainly the high spending they've been doing. Microsoft is building the infrastructure for the AI play, and the spending they've been doing on AI is tremendous. All right, I'm not gonna lie about that. They're buying a lot of NVIDIA chips. They're building out the infrastructure because they see a better future with AI. They see a new business line. Now, if you ask my thoughts, like Andy, you think AI is gonna be huge? You think AI is gonna be like this next best thing? I'll be honest, I don't know. I don't have the confidence in AI. However, I will tell you one thing I do have confidence in, and that is in Satya Nadella. And for you guys that don't know who Satya Nadella is, that is the CEO of Microsoft, and he has turned around this company from the lost decades of Microsoft, which we consider basically from 2000 to around 2009. The stock was basically flat during that time period, and he turned the company around. Although I may not be confident in I am confident in Microsoft CEO. I am confident that if he's saying that AI is a big deal, then I believe him. It's as simple as that. Now, this is not with every single CEO. All right. That's why credibility is so darn important, because if you don't have credibility, we will be questioning every single decision that you make. All right. With this AI play, I do think it can turn out to be another business line, can be something that exponentially grows the company. If worst case scenario, let's say the AI play does not work out, Microsoft, one of their biggest business line is still the cloud computing. I can imagine cloud computing to keep on growing, because for AI to work, for a lot of companies to focus on AI, one thing that it does require is a lot of data, and you need a place to store all that data. Hence, where Microsoft Azure comes into place. And I know that currently, right now, Microsoft is in an interesting situation where they're kind of moving sideways. I actually do have faith that if Microsoft wanted to turn it around, if they wanted to say, hey, you know what? Instead of building this infrastructure, if we want to focus on profits, make our company look good for investors, I think they have the power to do that. I think they can say, hey, you know what? Let's just cut down our spending just a little bit this year and boost up the profits. And as a result, I believe there is positive surprise to be had in the stock. And as a result, that's why I invest in it. Now, this is a stock that I have about currently four in this portfolio. Let me see here. I have about 54%. Wow. I didn't realize I had this portfolio is heavily. I have 7 different portfolios, so this is just one of the portfolios. So in this current one, I have 54% diversification in Microsoft. My average cost in it is around 340. I've been buying Microsoft since like around 150. I remember all the way from those times. This is a company that I believe in heavily. As a result, you can see how much of my portfolio diversity this is. And it's a company that I'll be holding for decades to come. Now, the next company that I have a significant size in this company is Costco. All right. Almost every single portfolio I have, I try my best to put Costco in as as a company. Now, the reason why I am so bullish on this particular stock is because, again, similar theme here, which is the predictability aspect. During 2020, I remember I had to wait an hour in line just to get into this freaking company to buy my basic supplies. During 2008, I remember this place was still busy. That even during bad economic times, the company can still make money. During good economic times, it can still make money. The reason why is because it sells groceries. That's something that no matter what happens, people need to buy groceries. So I like that part of the business. Another part about it is one thing that's interesting about Costco is that it makes money mainly off its subscription business, not off the actual margins itself. As a result, Costco has the same goals that the consumers have, which is try to sell the products as cheap as they can. Like, for example, the typical average margins that Costco selling their products is around 11%, whereas other competitors could be around 25% or even 50% margins. All right, that's something that every time I go into a Costco, I feel like I'm getting a good deal. I feel like I'm getting a value, and that's the feeling that I believe other shoppers are getting as well. And you know what's funny? A fun fact about Costco's membership is that out of 100 people that sign up for a Costco membership, 93 of them will re-sign for another Costco membership the following year. That type of retention rate that Costco has, that's even better than Netflix itself. Now, I do know that currently a lot of the retails are going through the issue of shrinkage or theft, a lot of people stealing in the stores. Not Costco, however. The reason why is because every time you got to go into a Costco, you have to have a membership to get there. And if they do catch you stealing, it's a very easy, clean case. They just cancel your membership. You can no longer shop there. A lot of the products that Costco does have, they are big and bulky. You can't just. It's difficult to steal like a huge set of toilet paper or huge set of the things they sell are just in bulk. All right, you can't just put them in your pocket and head out. As a result, Costco doesn't have the same issues that other retailers are going through with shrinkage. Now, what is my growth thesis for Costco? For me, currently they have around 800, I want to say 892 stores currently. They can easily increase that store count internationally. And that's my bold thesis for Costco. Not only international growth, but domestic growth as well. They can just currently create more and more Costco stores. And with each Costco, now in domestic Costco stores, each one is around 100 to 150 memberships. International, there's a lot more. All right. When you think about a country like China, where things are a lot more dense, that's where Costco has really been excelling. That's where a lot of these gains you see have been coming in for Costco. Now, I will give one thing to Costco, which is that the valuations are expensive for Costco. Currently, Costco is trading at a 53 PE ratio. And, I get that part. One thing I will share with you guys is that almost every time I bought Costco, it's always been at a high PE ratio valuations. It's currently at a market cap of $394 billion. And every time I buy into the stock, you're buying it at a premium. And, I am happy to buy this company at a premium because of the predictability it has, right? When a company is just having predictable stream of, growth, that is something that I'd be happily able to buy, pay premium for. Now, you might be wondering, why is Costco overpriced? Well, to answer that question, good companies are priced higher, and if they're priced high for a reason. That's the point I'm trying to make. If you want a company that's really cheap, you can find that there's so many of them. But are they the same quality as a Costco? That's something that you gotta ask yourself. Now, the third stock that I do invest in is Google. All right. So when I go into Google, Google's an interesting stock for me because it's the one stock that's been kind of holding my portfolio down this past year. And my portfolio diversity for Google in this portfolio is 7.29%. I have about 25 shares of it. And this is a company where I just really, really love the products. I'm not going to lie with you here. I use Google products every single day. I use YouTube, I use Google ad search. And currently, Google is going through a lot of issues with the lawsuits. All right, they're dealing with two separate lawsuit issues right now. One lawsuit is stating that Alphabet is a monopoly itself, and that they've already been charged as a monopoly, and there will be some remediation for that. The second lawsuit that Google is facing with is the fact that not only are they a monopoly, that they are a player in the advertising space. What do I mean by that? Just to expand on that, Yelp made a lawsuit against Alphabet in that they're saying that, hey, not only is Alphabet a platform where you can look up ads, the issue is that Alphabet is preferring their own ads over the competitors. Not only are they the platform, they are also a competitor against their customers, such as Yelp. And that's a separate lawsuit that hasn't been fully worked out yet. But these are the extra headwinds that's causing the stock to be valued at where they currently are right now. If we look at the PE ratio of Google, it is currently at a 23 PE ratio. This is cheaper than the S&P 500. Now, the reason why I invest in Google is because I honestly believe that at a 23 PE ratio, it's better than 50% of the companies in the S&P 500. That's something I truly believe in. Am I right? I could be proven wrong on that, but that's just my thought process. I believe the products. I love the products that every time I use Google, I feel like I'm getting valuable information. I'm getting usefulness. One of the things that Google does really well is growing the business organically. You look at the YouTube business, growing almost double digit. You look at the ad search business, even though it's going through the lawsuits, it's still growing overall. You look at the most important part of Google, its Google Cloud business grew by almost 25% the last earnings call. Those are the type of things that make me still bullish on the stock. Now, yes, could the company be broken up? It's very possible. That's right. But I think that's the worst case scenario. And I just don't think the worst case scenario is going to happen. All right. I don't know if the judge is going to have enough guts to pull that type of trigger because Google, not only are they dealing with lawsuits, they're also dealing with other competitors such as TikTok, such as Amazon. Because it's very funny how Google gets the worst of both worlds, all right? In one world, Google is this big bad monopoly that they have to be stopped. And in another world with Wall Street Journals, where they made an article stating that, Google's actually not that dominant. Google's actually losing market share to Amazon. They're losing market share to TikTok. They're losing market share to AI, chat boxes. So, there's so many headwinds going against this company. And as a result, it's going through a volatile time. I am still invested in this company even during this difficult time. I am buying more into it. I just love their products, and it's a company that I'll be sticking around for years to come. Now, my fourth stock, but my least, is gonna be Chipotle, and Chipotle is a company. It's new to the newest one to my portfolio. It's a food industry, right? But it's the one that gets me excited the most. And here's why I'll tell you why I get excited about Chipotle. All right. Every time I go into a Chipotle, I feel like I'm getting a good deal. I feel like I'm getting a good value, right? Because they're giving me $10 of a burrito, and it's the size of my face. All right, I have an oval shaped face, so my face is pretty long. Every time I go there, I feel like I'm getting so much food for $10, and the fact that when it comes to Chipotle, compared to its competitors, I feel like I'm eating real food. I feel like I'm eating food that is fresh. that I can actually bite the chicken. And sometimes when I go to other competitors, sometimes if I feel like it's too greasy or like I'm eating so much processed food, as a result, I see there's more cash flow increases to be had because that $10 burrito they're giving me, I would happily buy it at $11, $12, and $13. Because in the San Francisco Bay Area, if you want to go get lunch, majority of places are actually around $15 for lunch. All right. And I believe that Chipotle is able to make money at $10. I believe people will buy it at 11, 12, 13. Now, I know one of the biggest feedback I get is that so many people say Chipotle has fallen off, that they're no longer good as they used to be. And that's fine. That's the natural way of us older people thinking of how it used to be. You ever heard the expression, we used to have it way good back in the day, in the good old days, things like that? I am comparing Chipotle to its competitors today. All right. And today, when I go to the other competitors, they are selling things a lot more expensive than $10. The typical lunches in San Francisco Bay Area is around $15, not the $10 that Chipotle is going. As a result, with the cash flows, I believe they can increase through price increases. And I also think that with more stores being built internationally, that's more positive headwind for Chipotle. Now, one of the biggest thing that most investors don't like about Chipotle and why they don't get in is the PE ratio. All right, and I'm not gonna lie, it is pretty expensive currently. It's the highest PE ratio I have in my stock portfolio at 58 PE ratio. With that being said, I am still bullish on the company because I believe they can grow into that PE ratio. They can grow the company into that PE ratio because they can build more stores, have more cash flow. And not only that, their operating margin is the one that I look for the most because they're trying to work on being more efficient. They're building a more robotic stuff that can make the avocados for them. They're building potentially more robots that can make the bowls for them. Things that I see bullish in the particular stock. And with that, you guys, thank you so much for joining the portfolio. My name is Andy the Banker. Thank you so much, and I'll see you on the next episode. Bye bye.